let's start with our title sponsor. Ladies first, as always. Toni Ann.
Thanks, Weston. I'm Toni. I am the Chief Customer Officer at PortPro, and we are an operating platform for the drayage community, drayage trucking companies, and drayage brokerages.
I'm Matt Schrap. I'm the Chief Executive Officer of the Harbor Trucking Association. Weston's,
we're twins, but with different
information. He's better. And thank you to PortPro for all the support. So looking forward to the discussion.
And I'm Paul Bingham. I'm from Standard & Poor's, now called S&P Global Market Intelligence. I'm Director of Transportation Consulting, and I'm based here in Southern California, covering world trade and economic conditions, and I'm going to talk about that shortly.
Well, let's just go straight into that, Paul, because I think that if we want to start anywhere, we really want to start with what the numbers are saying. And as you and I have discussed a couple times, the numbers are not linear. They don't all make sense. They don't all connect. And typically there are certain key indicators that you can predict everything else that's going on from a numbers perspective. You can't cheat. You got to do all your homework nowadays because none of it really has the same cause effect that we've traditionally seen. So walk us through what you're seeing. I mean, S&P Global, the Journal of Commerce has some of the most sophisticated and best analytics about the industry, what's going on. You have really great tools to help forecast where you think the economy is going. So talk a little bit about what we're seeing, where we've gone over the last 4 to 6 months, and what's some of the nonsense that is the analytics hurricane that we're seeing is showing us.
Let me start. And for some of you, you saw the supply chain meetup panel discussion we had similar to this back in December. And then many of you were at the Journal of Commerce TPM conference back in March, where we talked about a lot of these same issues. Here we are in the middle of May, and things don't look even the same as they were in March, let alone back in December. So why is our outlook, our forecast, our short-term forecast, really at that time, not panned out exactly as we had thought? And I'm going to go back over a little bit of that. But to get to Weston's point about, well, what's been going on here? Why are there some components of demand and the factors affecting trade volume and the activity at the ports that haven't gone exactly as we were thinking back in December? And it starts with a combination of factors like shocks to the system we didn't anticipate, but there's also some fundamental factors that we didn't get exactly right, which is like the strength of consumer demand. Something as fundamental as the underlying demand in the economy, households' willingness to spend money, to go into debt even to continue to consume, has been at a little faster pace than we had been thinking back in December for a number of reasons, and I'll go into some of those. But let me give you a top-line view of how much things have changed. In December, we were saying that in 2024, the U.S. economy was going to slow from where we were in last year. We're still saying it's going to slow, but not nearly as much. Our forecast then was for GDP growth of 1.5%. We're now saying it's going to be 2.5%, which is not really that far off of the potential GDP growth on a sustained basis in the U.S. economy. So that's a much stronger outlook, even though it's still weakening, not nearly as much. And part of that's due to trade, but even the trade situation has not evolved as we were forecasting exactly either. Where we were saying exports were going to stay a little bit stronger. Exports were positive last year while imports were down. We know we had a bad year basically in 2023 compared to the prior year where trade volumes had fallen. We've been forecasting a rebound in imports, but imports have come back faster and exports are not growing as quickly. And from a GDP perspective, you look at net exports. So that's actually a drag on the economy. And despite that drag of faster imports, slightly slower exports, we're still forecasting stronger GDP. So there's other factors at work besides that. And now, and let me qualify all of this. We're talking right now at a perspective of the country as a whole. And I'm going to get into some a little bit more on the West Coast split on that in a minute or two. So fundamentally, consumption is stronger than we had been anticipated, and that translating directly through it combined with inventory buildup into some of the trade demand volume that we're seeing. And that consumption growth for the year we're forecasting now at 2.6%, which is not that far away from the rate of trade growth we're seeing. And this is at the same time we're seeing industrial production is still pretty much flat. We were forecasting that, maybe even a little bit negative in December. We're still saying that for the year. So it's not coming from production in the United States, the manufacturing activity drawing in components and imports. This is more coming from the consumer side of finished products, finished goods coming in as imports, especially those are on the container side. Our forecast of trade at the very top level, and I have to qualify all of this, all these forecasts were done before the announcement of the White House on the tariffs that are being imposed on an additional $18 billion of Chinese goods. So we can talk about that qualitatively. I don't have that modeled yet, but anyway, these forecasts. So we had been forecasting back in December that exports were going to grow this year at 3.9%, not far from where they were last year. We're now saying exports are going to grow 2.4%. One of the reasons for that is the dollar has proved stronger than we had been projecting for a number of reasons, including factors that are not fundamentals in the economy. It's just the flight to safety, the perceived risk factor. So when the dollar is stronger, our U.S. exporters are less competitive, and that means they're going to be weaker in terms of being able to capture foreign markets and growth in this year. Plus, some of the foreign markets, not all of them, are weaker this year than we've been anticipating a little bit for a number of factors. And on the converse side of that stronger dollar tends to dampen some of that import price inflation, which then makes the volume of imports actually faster than we would have seen otherwise. So that strong dollar tends to boost imports, hurts the export side of the economy, and we're seeing that in the numbers that we're forecasting. Now, our total trade growth for the year on the import side of 4.2%, which is about 0.5% more than we were saying back in December. There's a number of factors that we can translate back into some of the container demand. Another factor we look at sometimes for big volume drivers on TEUs are things like furniture and fixtures. That gets tied to the health of the housing markets. We're saying now that that the housing starts are going to be a little bit stronger than they were being forecast in December, but still down from last year. It's still a weak housing market with very high mortgage rates. And because of that, housing starts are not growing as much as you would think they were. And yet there's a flip side of that, which is people staying in their homes. The asset values, the values of their homes is contributing to a wealth effect. And because of also the strength in the equity markets, the stock markets, the Dow Jones Industrial Average just hitting a record high yesterday, and our S&P 500 in our company also very high levels. There's a wealth effect for those that have some assets in 401ks and other aspects of their investment portfolios that encourages some spending because they don't, even if they're going into taking some credit on to do that. And then another factor is business investment itself, how much businesses based on their cost of capital, their outlook in terms of markets for sales. And we've increased our forecast for business investment this year, also about 0.5% up to 2.6% for the year. Some of that business investment is where you calculate the value of inventories. And there's been more inventory calculations, getting a little bit closer back to that pre-pandemic level of inventory to sales ratios that have been running beneath where the long-term optimal target rate would be for that, essentially rebuilding inventories. Even though you've still got some warehouses in some segments that are overflowing, there's other sectors like autos where actually still trying to build back to that long-term sustainable level of inventories. And then let's talk specifically on container trade. So for the world last year, we had trade growth was actually negative. There was a decline 2023 to 2022 in the total volume of containers moved global. And map that against the growth in vessel capacity, we saw that historic drop back in rates dramatically last year. And into this year for the container markets globally. That was a reflection of that weak demand. We saw it here in the ports and around the country in terms of very soft total volumes and weakness in imports, especially last year. We're forecasting this year against a weak global economy of about 2.6% GDP growth globally, of TEU growth globally at 2.3%. We're forecasting the TEU volumes for the U.S. being faster than that for the year. In fact, we're forecasting it closer to almost 9% growth this year in total TEU volume growth over last year. So in some ways, last year was artificially depressed as we drew down inventories and had a shift of spending away from goods towards services. Some of that's normalizing back, plus the inventory rebuilding and the shift, especially into the consumer products, in terms of the types of imports and exports we're talking about, means that it's more closer to a 9% growth year over year in total import TEU volumes. That's very strong growth. Now, there's going to be a regional split in that. If we look around, how is that going to be affecting ports around the country? Obviously, for those of you that were here early this morning, heard my Journal of Commerce colleague within S&P, Bill Mongaluzzo, say because of all these combination of factors affecting coastal share splits this year, the biggest impact in terms of that growth in trading right here in Southern California, and it's certainly on the West Coast compared to the East Coast. And I won't reiterate all of that, but in fact, we can talk more about that in Q&A. But that that's the combination of factors like the problems with the limitations on transits in the Panama Canal, the cost of canal transits if you auction to try to buy a slot auction to get some of the reduced daily transits, and then the effective closure economically for risk reasons of the Suez Canal, all that rediversion of traffic around around the Cape in Africa, longer sailing times, less efficiency, and using up some of the available vessel fleet capacity to take that extra sailing time into account. And then layered on top of that, shifting the East Coast Labor Union contract expiration this year and the concerns and risk mitigation around some potential threats of port disruptions on the Atlantic and Gulf coasts, put all that together. The prudent supply chain managers this year, when they're placing their orders and thinking about port choice, are looking to the West Coast, just like they did port risk mitigation in the threat of the ILWU contract expiration disruption to shift things away from the West Coast. Now that's swinging back, and not just reverting to where it had been, but actually some mitigation to avoid some risk and exposure to East and Gulf Coast ports on top of what's happening with both of the big canal routes. If you add all that together, the pressure is here, plus the performance has been sustained on the Southern California ports, so supply chain managers were not worried about port congestion or unavailability of chassis or the other potential problems recurring that were there during the pandemic that had driven some of them to move discretionary cargo away. All that's been working in reverse, bringing trade growth that we've seen at double-digit rates in terms of year-over-year growth here in Southern California. And I think that's where I want to leave it for prepared remarks, and let's turn to discussion.
And so, Matt, we'll bring it to you because typically in our industry, volume is the key indicator of everything that we see. When volume's up, ironically, typically you have longer turn times, so you can move less containers as efficiently. Because of those capacity constraints, rates go up in the market. And, those are two of the great examples of the fact that volume's up, but turn times are still really good. And in fact, some cases faster than they've been in quite some time. And the poor trucker can't figure out how to make a margin on the moves they're making, despite the fact that we've got record volumes coming through. And so without violating any antitrust agreements out there, Matt, can you talk a little bit about, from the trucker's perspective, operationally, what's going on in the market here? Because a lot of the data that Paul just brought up is not indicative of what we would think to see boots on the ground. In fact, it's the exact opposite.
Yeah, absolutely, Weston. I mean, one thing that Paul brought up, thank you for not saying there was a shortage of chassis during that process. It was really about availability. And we have plenty of chassis now, right? And I think that that's indicative of where we're at on the volume side. And it's counterintuitive to see higher volumes with shorter turn times. But one thing, especially from a rate perspective, without getting into antitrust issues, of course, is that shippers must be still looking for a pound of flesh from the pandemic, because rates are some of rates that we're seeing comparable to 2002, even lower. And so it's challenging to try to sustain a business, especially with all the downward pressure from regulatory policy, whether it's labor or environmental, to maintain a profitable business in this marketplace. And as you're, being challenged by marine terminals for securing appointments, limiting the ability of using third-party software because they don't want us to pull the veil back on some of their, predatory practices when it comes to detention and demurrage billing, that we're seeing now that there's still this tremendous amount of downward pressure, and shippers aren't necessarily working directly with their trucking companies to understand what those costs are. And we're talking long-term contracts that have been in place for years with shippers who are now coming back to motor carriers and removing that freight, going to somebody else who's literally charging $10, $15 less. And so that makes it very difficult to try to exist in a marketplace, especially when we juxtapose that against terminal efficiency. And while there are, quicker turn times than we've seen in some time now, the volume numbers don't really pan out necessarily. You would think that we would be seeing longer turn times with more congestion, with more volume that's coming through. And again, while we're trying to be as efficient as possible, we have these other constraints such as mandatory enhanced roadability coming out of certain marine terminals where ILWU is trying to claim jurisdiction over chassis that are owned and maintained by trucking companies in order to justify additional maintenance positions within their local unions. And so we have all these things going for us between pirates and strikes and droughts, oh my, but we're still kind of forced against this wall where shippers are not necessarily paying commensurate with the service that's being provided. And as we're moving into the future, it's really exciting to see all these electric and hydrogen trucks out there. I feel like we've spoken about that at length today. One thing we haven't really delved into, besides some of Paul's comments and then the comments that were made this morning on the panel, is that we have a major sea change coming in how per diem is going to be billed under the FMC rule. And the challenge becomes that for motor carriers, we're working with their shipper partners to try to clear demurrage to get a box off of dock. If you couldn't secure an appointment until your last free day, and then you perhaps missed that appointment for whatever reason, or you can't find a driver to work at 11 o'clock at night after the dinner break on a Thursday, that you're finding yourself now subject to demurrage charges that you must pay, and then go through the motions and trying to challenge it with the terminals and the steamship lines coming back and saying, well, you need 2 different screenshots from every single terminal that potentially from either from on the per diem side for that empty return or for the ability to pick up that container. So it's challenging. You know, drayage is not for the faint of heart, to say the least, but right now with all of these regulatory pressures, outside pressures, considering where we're at with volume, where consumer spending is at, how we're shifting back, you look at the February volume numbers from the West Coast Trade Report from PMSA, we're well above 2019 numbers. Where 2023, again, we were in, you know, to Robert's use a term that Robert would use is, you know, in the shitter, so to speak, from a volume and rates perspective, that now we're trying to now react and have these conversations proactively with shippers. And frankly, it becomes very frustrating because I don't think they truly understand the cost of what we're going through doing business, not necessarily just on the West Coast, but globally. Many truck operators say we're still in a freight recession because rates are so depressed. So we're constantly working with our membership. We're trying to be proactive, work with the terminals, figure out creative ways and how we can try to either flex gates, work through breaks, make sure there's enough transtainers available, try to open up more appointments, exemptions, etc. But these are piecemeal temporary solutions. And it's challenging because it's not like we have a feeling from these operators that they are trying to embark upon a long-term solution pathway. It's more reactionary. And so ideally, as the volumes continue to move, as we have the uncertainties, the geopolitical challenges that we're looking at, that hopefully shippers will start to recognize some of the challenges we're under and start pressuring their customers or the folks that they're working with, i.e. the steamship lines, to really start thinking about what we can do to be more efficient, to move more containers in a more effective way without extorting trucking companies and shippers for fees and charges that shouldn't be applied in the first place. So that wasn't any antitrust, but I'm usually full of good news typically. So looking forward to the discussion.
Well, and I just want to point one thing out, because as you've talked about, you know, inflation's still high. Like, that's one thing that we can connect between the first 2 speakers. But what's interesting is if you go back a couple of years ago, the discussion around inflation was we got to bring down transportation costs because this transportation related inflation, yada, 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 right? Well, now you still have inflationary economy. Once somebody raises price, we talked about the excise tax in the last panel. Once a good tax goes into place, even if the reason it got put in place goes away, the tax doesn't. Typically, retailers, unless they're trying to get competitive and grab market share, they don't lower the price of things, especially in the consumer goods market. So what's interesting is while we've seen inflation continue to rise, it's not due to transportation anymore, and that part is got to come back to, well, then why are prices still so high and why are they going up? And I think that's probably for the next 6-month check-in, Mr. Bingham, will be why do we continue to have this inflationary economy when a lot of the driving factors for inflation have gone away? And in fact, the prices have gone backwards.
Well, in fact, that's a really good point, and I didn't elaborate on that. The inflation story is an odd mix of what happened, and we're all very aware that because of the supply chain, pressures that exist in the pandemic. We had sky high prices where it was goods demand initially, not services, that saw the inflation, 40% high inflation on the goods side. And you're absolutely right. The goods inflation is gone. In fact, we've got sectors where we've had deflation in actual goods prices from where we were in 2021, 2022. But overall, that consumer price index, or top line everything, is still running at over 3%. And when the central bank, the Federal Reserve Board, saying the target's 2%, our forecast in December was for this year we were going to be at 2.4% by December. Now we're saying it's going to be at 3.3. We have inflation that's still running. It's running hot. It's well above that Federal Reserve Board target. We had been assuming that the Federal Reserve Board was going to start to reduce their interest rates, bring that interest rate pressure down, starting next month. We'd been assuming it was going to be in June. Now our forecast is that's not going to happen until December. We're talking that we're going to have these sustained high interest rates working through all the cost of capital, mortgages, credit card interest rates. Everything in the economy is going to be there through December while we're trying to fight this inflation. And some of it comes to the stickiness point of like retailers and others, and especially on the wage side. Unless you're paid by the unit of something, like by the mile, but if you're paid by the hour, those wages don't move down. They may stop going up, but they're not going to be coming down. And then we've had things like, minimum wage rate increases and other factors in sectors of the economy that help keep that pushed up. And service prices overall, if we look at other sectors, other parts of the economy, some of those service price inflation is still pretty high. It's still well over 3%, and it's part of what's contributing to that top line number. So inflation is still a problem, and in some ways it's still the biggest problem because it's keeping the central bank from actually getting off the brakes in terms of the economy and letting it grow more. That's not going to happen now, and that's one of the reasons we've got the economy and the outlook that we do have.
And with all those headwinds, wouldn't it be great if we had some sort of guide for success? Oh, wait, we do. Toni, that's why you're here. Talk a little bit about, you work with so many fleets. You provide, great software that help them try to optimize their processes and their operations throughout the day. You guys have published something called a Drayage Carrier's Guide to Success. So we've talked about the problems. We've talked about what's going on. Talk a little bit about different things that you guys are doing with the fleets that operate on PortPro to try to help drive down some of those costs so they're able to have a margin that they can still go home and, eat something more than gruel at the end of the day.
Yeah, so traditionally in the industry, when volumes increase like they did over the pandemic, drayage companies will go out and hire a bunch of people to do pretty rudimentary things like track containers and book appointments, etc. And then in a down market, they end up needing to let all those people go. So that said, I think it's more important now than ever for drayage companies to work smarter and not harder. To your point, with volumes increasing, rates being the same or less, and wages being high, drayage companies need to really figure out how to manage this increase in volume. And the only way to do that, besides going out and hiring a bunch of people and then having to let them go when the market turns back down, is by implementing technology and automating a lot of their processes and workflows. So like you said, earlier this year, my team and I actually put together what we call a Drayage Carrier's Guide to Success. And in this, we identify really 8 key strategies that drayage companies should take to automate a lot of their workflows and do these things to help solve for the problems that we're outlining here. And those strategies are: 1, connect via API and EDI to as many of your customers as possible. 2, send automated email notifications and reports to your customers. 3, automate your appointment scheduling process. 4, transition to a fully electronic documentation workflow. 5, give your customers access to a customer portal where they have full visibility over their loads with you. 6, automate your container tracking. 7, automate your customer rates. And then 8, dispatch more efficiently via a driver mobile app. So
before you go forward,
yeah,
I have a quick question. How many of those 8 things can you accomplish when you transition to a new TMS system that might, make some of those things easier from an integration standpoint or a data flow standpoint or a process standpoint?
Yeah, so I mean, with PortPro, it's all of these 8 things are possible because we're a modern web-based system. We have APIs. They pose more of a challenge when companies are obviously running on spreadsheets and paper and pen, or even server-based systems that are primarily EDI based. And what these 8 steps really do is they just really allow you to cut out a lot of time spent on doing all these tedious, repetitive tasks, like all the back and forth communication via emails and text messages to your customers and your drivers, logging into 12 different websites to book appointments. And so if you implement these strategies, you don't need to hire as many people, to do these tasks manually. And just one quick example that I'll share. I know Manny's from Talon Logistics. I don't think he's here anymore. He's probably down by
He's
the bar.
at the bar. He said something about a frozen margarita.
Yeah, but he's that's exactly what I'm going to have after this. He's a perfect example. And we recently did a case study with him where after implementing PortPro, his dispatchers saved on average over 104 hours per week, and his drivers save almost 2,000 hours per year just by implementing those strategies, and automating their container tracking and dispatching to their drivers via mobile app. So
Yeah. I would implore everybody, if you do not have a TMS, please get one. In my previous vocation, I remember acquiring a carrier who was still operating on AS400 green screens, and my goodness, that was a blast from the past. So modern technology, do not succumb to the sunken cost fallacy of, well, I spent money on this 30 years ago and I'm going to get every penny out of it. Sometimes it's okay to throw things out and start over if it helps you moving forward. And I would say, don't be penny wise and pound foolish. Adjust your CapEx to make your OpEx work for you, because at the end of the day, CapEx is not typically what bankrupts companies. It's inefficient OpEx. And if you continuously have to spend more on your operations because you don't want to spend a little bit more on the front end to create a CapEx that allows you to scale with less resources from a day-to-day perspective to manage your increased business flow, you're going to be hurting. But if you're able to do that and scale and have every dollar invested create $2 of savings or $2 extra of revenue, guess what? You're going to grow and you're going to create margin. So don't be part of the no crowd.
And on that point, Weston, and kind of understanding how to control costs, one thing that we're seeing now is that terminals for those API connections are looking to start charging on either a per container basis. It's not even a setup fee. And so they're seeing a revenue generator because they're needing more revenue. Some of them are not seeing as much, I guess, capital exposure that they had in the past, where now they're taking any opportunity they possibly can and going back to trucking companies and saying, well, your TMS provider has been getting this for free and charging you for it. So we're going to charge them, which ultimately trickles down to the trucking operator in higher costs. So sometimes these external challenges, as much as you try to plan, without this holistic approach, especially working with customers to try to put pressure on some of their ocean carriers and their terminal partners, you're going to be experiencing more nickel and diming and, as we call it, the monetization of efficiency. And while we can save money with being more efficient, some of these terminal operators, especially down here, I won't name one, it's in the port of LA. It's not Pier 400, Ashley, yet, but we're still in this process of trying to explain to them that this is better for everybody, but they see dollar signs. And so that can become challenging, and why we really need to think about having these conversations up front so we can understand their challenges, they can appreciate our challenges, and they're not just trying to make an extra buck off us at the end of the day.
So what you're saying is, for a drayage provider, the nickel and diming fees are a terminal illness.
Yes.
Got it. Paul, one of the things I wanted to go over with you, and I know Bill brought it up earlier, but one of the things that we've seen drastically rise since the beginning of the year that is a normal indicator of volume is the rail dwell, right? The amount of time rail containers, intermodal containers that are set to go to Chicago or Memphis or wherever are sitting at terminal to be able to be loaded on the unit train for the oh so precise scheduled railroading that they operate. And I guess my question to you is that seems to be a normal indicator. So one, for those in the audience who don't know, what are some of the big impacts that happen when you see an increased amount of dwell on rail containers? But then also, why are we seeing it in the rail industry where in so many other elements, especially in trucking, we're seeing inverse correlations?
Well, I think the capacity, flexibility, if you will, between the two modes is very different. Obviously, in trucking, despite all the regulatory hurdles you face and cost of capital, it's still possible to scale things more quickly in the aggregate because, if nothing else, you have different decision makers. Whereas for the railroads, you have two Class 1 railroads effectively is what's serving all of the West Coast. So if they don't make the right CapEx decisions and they make them a year at a time and they make decisions about their workforce a year at a time, they've all gotten sort of caught out going back into the pandemic of having, shed too much of their workforce, trying to pare costs to please, my colleagues in Wall Street rather than their shippers and their customers. And so their flexibility to shift assets quickly back where the market has shifted, and clearly it's shifted from the east to the west coast here, they're not keeping up, and they haven't caught up by those dwell times going up. They're trying to make some adjustments, but it's difficult for them when they have very deliberately, like you said, tried to pare back their asset investments in their entire network over the last several years in the chase of lower operating ratios. That they're pushing costs back onto their customers. And one of those costs is not just the rate issue, it's the service quality and their capacity. So one of the ways that they're saving money is by not offering enough capacity. And that's where we have the Surface Transportation Board in Washington, D.C. going after the Class 1 railroads for
been very effective too.
Right. So
sorry, go ahead, Paul.
So I think I'm saying that's an indicator of the network performance. It's also just reflecting the market shift in terms of share. There's also some other issues with the domestic versus international intermodal in the rail business, because they also have a domestic business which is separate from the IPI international, which you see at the ports. But some of that capacity in terms of locomotives and crews and other things are essentially shared. And there's some issues even in that in terms of what's the share that's going over the road full truckload versus what's going IPI, whether it's domestic or it's the international ISO containers into those midland markets.
Yeah, and we'll get to questions in just a couple minutes. But Matt, then again, operationally, the longer that we start to see the increased amount of rail dwell at a marine terminal, obviously it impacts trucking operations because marine terminals only have so much space. So whether it's fulls going out, getting priority, or really empties coming back where you only have so much allocation, the amount of containers that can be on terminal for a steamship line, right? Impacting availability of local containers that need to go back for truckers. What at the HTA level, I know it was brought up on the panel earlier, Robert was brought on, but what are some of the concerns that everybody's looking at? Because obviously when the railroad's not efficient, we see the impact on trucking, and some of these efficiencies that have somehow held true with this volume increase that we've been seeing, they may evaporate very quickly.
Yeah, absolutely. Like our friend John McLaren has said before, you can't violate the laws of physics. There's only so much space to go around on marine terminals. And when they prioritize particular colors of containers over others because they have vessel allocations coming up, they have, slots that have been determined, and closing out empty container returns or requiring dual transactions makes it difficult because now we aren't able to react. We're no longer in the random access model. We're required to make appointments several days ahead of time. We're looking at, unless you're especially utilizing some third-party software, you're literally maybe hiring people in the Philippines to sit there and hit refresh constantly, hoping that an appointment comes up. And so as the terminals fill up, they start putting outward restrictions on, which prohibits our ability not only to return empty containers, but to find enough appointment slot time to pick up that loaded import on dock. And, there's been much accusations against the terminals about gamesmanship, limiting a certain SCACs towards getting appointments, prohibiting other ones. I will say we've made some strides, especially in missed appointments. Probably when I started in this role in 2021, the number of missed appointments was around 30%. that number has come down into the single digits. And in no small part of some of the efforts that the HTA has done in communicating with terminals in understanding how an auto cancellation system could be effective, how there could be a push notification, how there could be, empty return exemptions for, on a certain day, or whether they can work with the terminal to create peel piles. So the more congestion that's on dock, the longshore has a harder time moving around. They're touching containers several times in a yard in order to accommodate new vessel space or new containers coming off vessels. You have vessels building up outside.
And more headcount.
And more headcount, right? They like that part though. But suffice it to say, as we kind of deal with the labor issue for their efficiency side, for our ability to be able to react in a capacity standpoint to retrieve containers or again return them, the more congestion on the terminal, the more difficult our lives are going to be because we can't operate efficiently. I will say that it did take the pandemic for the port authorities to really appreciate some of the land that they have. I know Port of Long Beach was very proactive in setting up Pier S or the store facility, but somebody's got to pay for that. Someone has to pay for that dray from the terminal over to that near dock location, and that's usually the line. And you just might be surprised they don't like to pay for a lot of stuff, or they'll try to put downward pressure onto drayage carriers to do moves when at a lower rate just in order to get the business. And many motor carriers are taking the business because it's all they can do. And so this keeps compounding, and especially when we look at gate closures, they blame it on volume. We're working with Blue Cargo on a project for several months now, tracking the amount of gate closures that happen on a weekly basis. We call it the checkerboard effect, that if you look across both gateways, across all 12 terminals, you can see opens and closures. We don't have 100% ability to retrieve containers. While some terminals run hoot gates or they do the flex, we're trying to get them to start doing double flex, which also costs double for labor, that they're hesitant. But as we are looking at this data, we can clearly see that there is not the 100% opportunity to pick up containers. Some of them are in the 70s or 80% of total overall gate availability based upon the Wickham Tow agreement. It says 5 days, 4 nights. I think it's pretty clear, but they also have the ability to manipulate that within that agreement based upon whatever needs they have. And so they blame it on volume. They close day side because they need to keep night side gate open so they can keep their steadies because they don't want to lose their steadies back to the hull. And so they start manipulating the ability of motor carriers. Longshore may see this at some point in time, so I'm going to tread lightly on this, but I hear service really drops off after the dinner break for various reasons. And so convincing a driver to go in at night, especially, and that's the only appointment that you can get, convincing them to go in at night, you pay them a premium. If you're in the middle of a dual transaction, you could literally be shut out and sent home. That's a dry run. No one's paying you for that run. That's a cost that the motor carrier needs to eat. Another thing that we're experiencing now too is these free chassis that ocean carriers are including in their ocean rate on a pool chassis. You have an empty container that needs to go back in. It's on a chassis that was provided by the marine terminal, but the only way to get that empty back in is through a dual transaction. But now you're forced then to use that chassis in order to pick up a box on dock when you're paying rates that on the pool rate side, outside of the agreements you might have with your own IEP, which could be much lower. And so these things keep compounding over and over again and pushing this downward pressure on. Again, the regulatory side is one thing. From an efficiency standpoint, if we can't move containers, we're dead in the water. We're storing them in our yards or sitting on top of chassis that can't be used elsewhere. It's just a compounding effect. So any congestion on terminals is really going to have this trickle-down effect of limiting our ability to be efficient. And the conversation sometimes that we have with terminal operators is like, what do you want from us? You go to the line, you start complaining. Their answer is, we don't control the terminals. So somewhere, somehow, something has to give. And we're trying to keep up the dialogue at HTA. And we've come so far since we started in 2010 that we're really now looked at as an indicator of overall terminal efficiency between our turn time program, between the Blue Cargo program. And frankly, when you start looking at the data, you tell your shippers, it's like, well, the terminal was closed. I couldn't retrieve the container. Now you have to go back and start fighting with them in order to get per diem or demurrage waived because you couldn't pick up the container, but it was already in free time. So they're going to continue to charge it. It's just this never ending circle that frankly becomes very frustrating for motor carriers and for a small operator, especially who's doing dispatch, who might be driving, they're doing their books. When you start needing to hire all this headcount and then you're spread so thin, you don't have the ability to react. And at the end of the day, the customer suffers because you can't move that cargo. So it's just compounding on top of itself.
And I've got a question for Toni, but before I go there, if anybody in the audience has any questions, act like a trucker during the pandemic. Cue it behind this microphone. We'll get to you when we get to you. But Toni, a lot of what Matt's talked about, operating a software system, if you read anything, watch anything, people love buzzwords, AI, big data, blah, blah, blah. How far away do you think we are from actually being able to go, Siri, dispatch my trucks for me?
Actually, earlier we did 2 demos on our new embedded email inbox that's integrated within our system, with its underlying foundation being based on AI. So Michael, our CEO, was talking about earlier, like AI and dispatch automation, recommendations, automations, like that's coming, and it's coming really quickly, as in like this year. We are working on so many different things as it relates to AI. Just as one quick example, when customers set up their rates in the system, their customer rates in the system, our AI will actually read an email thread. And there's so many times as a drayage company, you're BCC'd on emails requesting quotes, and a lot of our customers say, we respond to 0 to 5% of those emails when we're BCC'd. Our system will actually read the email thread, understand that it's a quote, read the quotes that you have set up in your system, and automatically reply to those BCCs with quotes. So these are things that are already here and are only going to get more and more powerful as AI, learns and adapts really fast.
Well, I don't see anybody that has any questions, so I'm going to make, come on up, because I hate to be the guy that stands, I hate to be the guy that stands between any of you and a bar, and it sounds like there's one heck of a party going on out there.
It's the... For example, So for example, we're still kind of on like a V1 of the dispatch automation. However, there's things like you can prioritize certain customers and ensure that the system recommends based on those preferences, load preferences, customer preferences. So for example, if you have Walmart and Walmart has a last free day of today, and then you have Nike that has a delivery appointment today, you can set preferences like always take, this customer. So if you only have one truck available, we're going to recommend that you dispatch it to the driver for this particular load. Like that's just one small component of it, but that just gives you an example of how dispatch automation via AI works.
I would say this too. AI is still in its infancy, right? And so, like any technology, over time it will get better. But the best technology in the world depends on quality data, and the data in this industry is shit, to be honest with you. And so, and a lot of people hoard it and don't share it. And so we need to get to open data standards where you can see what's going on with turn times at the port, and you can see what's going on with appointment availability, and you can trust that data, and you can see traffic patterns going to and from, and over time, AI learns. But these are large language modules who require a lot of data, and it has to be quality data, because in the beginning, if you're putting bad data in, it will learn how to do things wrong. It's no different than raising your children, right? If you teach them how to do something wrong, they'll grow up to be shitty human beings. And that's what is going to happen with your dispatch system. So I think it's one of those things that over time, you have to be able to train it. There has to be a human oversight of it today. But that's why I asked the question in a very tongue-in-cheek way of, at what point in time do you think we get to, hey, Siri, dispatch my trucks? Because there's a lot that's going to go into that. And to be quite frank, it's not as dependent on the people building the technology. It's dependent on everybody in this room being part of the solution. Yeah.
What kind of follow-up are you referring to? How do you communicate with your drivers right now?
Yeah. It can't replace people today. To your point, today, it can't. That doesn't mean it won't be able to in 5 years or 10 years. But I also would say this. We live in a relationship business, right? It's really about automating processes, data flow, and how much better would it be if you have all this data that you're ingesting on traffic and turn times and availability in a dynamic sense where you can literally have a couple scenarios the dispatcher has to choose from to do the follow-up as opposed to have to do the heavy lifting problem solving themselves. That's the first phase of it. I also would say I don't want to live in a world where there's no human interaction, but I think it's all about giving people the tools to be able to act smarter, the whole work smarter, not harder paradigm. And that's, like I said, it was a loaded question, but nobody queued up in my line. So that's why. But I really think that these are the types of things we have to understand, because to get to that point, we're going to have the right type of data inputs and the right type of data quality and the right type of integrations and everything else to make it work. Since we have no questions and since there is one hell of a party going on outside, I'm going to...
Okay. And I do, and let me, just 1 second, because as you talk about this hoarding of data, right? When we sent a letter to the ports of LA and Long Beach at the beginning of 2022, asking them to embark upon a process in order to implement a single agnostic appointment system, so we're not jumping between several different modules in order to schedule containers in our drivers and dispatchers' day. It was like, I was told I would win the Nobel Peace Prize if I could get Mario Cordero, the executive director of the Port of Long Beach, and Gene Sriracha is his new nickname, according to the Lieutenant Governor, Gene Soroka, excuse me, he's a good friend, but to get them to agree on something. And as we kept going through, then there was 2 different tracks that were happening. Then you had the state coming in saying, we got money to give to you. And when I would talk to the terminals, their first thing was like, well, hold on, we don't want to replace our systems. The idea was like, no, you integrate, you API in, you have the ability to have a single dashboard.
Anybody heard of Expedia, Priceline,
Right.
Orbitz?
Yeah, exactly. And what I was drawing out of some of these terminal operators is that they were afraid if they were going to start submitting this data that the ports were going to somehow use that against them somehow. And so there's this fear. And you look at the data that the Port of LA releases about appointment utilization, they go to a terminal and say, hey, how many appointments can you handle in a day on the dayside shift? 1,000, right? That's just a random number because of row closures, because of other gate challenges, that they aren't necessarily handling 1,000 appointments, but it looks like we're only booking 50% of the 1,000 appointments. They don't take into account volume. They don't take into account anything else because there's this fear, I guess, of it being used against them at some point in time. And to the point of like with the human side of things, I've seen Terminator 2. I don't know what you guys think about AI, but to me, it's a little scary sometimes thinking about replacing humans. But it is the future, but we need willing participants in order to provide that data so we can have more clarity, so we can be more efficient. And it just seems there's this unwillingness and this protectivism that's preventing real true efficiency gains. It's mind-boggling sometimes.
So last question, and then we'll do closing statements, and then it's hasta la vista, baby.
Yeah, so and I'm never one to want to impugn on any growth of industry, like the electric, everything on electric. But I see like a monopolization with doing so, right? All the small guys, all the small truckers, independent, they're gone. It's too expensive for them. And have they fully thought it all out, by the way? So everything going electric here?
That is one of the goals. So yes, they have. But go ahead.
Have they? So like when you're going outside of here, right? You know, if you're pulling in and going to Arizona, Nevada, Texas, or all the way across, is everything set up electrically already nationally?
No.
Do you see what I'm saying? So, and then there are some people who are fighting that right now. For instance, you have the Attorney General from Nebraska and from Iowa already suing and challenging.
Yeah, remember though, the California Trucking Association set the tone. They were the first ones to sue the ARB. They've sued the ARB several times. They've won. Well, I'm hearing you. And the Biden bucks they're out there, they're trying to build a national charging network. And it's not just electric, it's hydrogen also. So from that perspective, this is the challenge. The small operators, there's a perspective here in California that the unions have been driving most decision-making in this state, and to get rid of that small fleet owner. We don't even use the term owner-operator in California anymore.
Partner
Carriers. So as kind of the politics that we evolve in, the question, I said no, Weston said yes, they've kind of thought it through. It's like, it's pretty half-ass approach that they're taking here. And, at the end of the day, when we think about, well, are they going to survive? It's hard to say. It's hard to survive right now. There is no mandate because of the CTA suing. And then you have Bill Barr and you have the Nebraska Attorney General jumping on the bandwagon, finally realizing that, oh my God, all bad ideas do start in California. It's like, where have you people been? We've been putting out warning signals for years about short-sighted regulatory policy. Yeah. Right, exactly. We've been beating the drum.
Costs continue to go up, right? Because so as a trucker, what are you going to do? You're going to increase what you're charging. Why? Because it's affecting you. I have to invest in this. How much is it? It's a lot of money.
Yeah.
The truck and the charging port, right? And one more thing, I don't want to lose my gas stove. I'm sorry. Do you like cooking?
I don't want to lose my gas stove
it's
either.
Bad for your health, though. So
I do a good culinary evening.
Pick your poison.
So what I would say with this, a lot of the stuff that we've just addressed in the last 10 minutes, it's all in its infancy, right? And over time, technology just gets better. And right now, it is about the people that want to invest in these different technologies. They want to be pioneers and trailblazers. And there's subsidies available right now, and it's the most expensive, and there's the most challenges. And over time, how many of you had a cell phone in the 1980s? It was a backpack. And now you have a full-scale computer that is right here. And the point is that battery technology, for instance, gets smaller, faster, cheaper. And so it will not be everything to everybody. And for some people, it'll be nothing for them for the next decade. However, that's what has to happen. The federal highway system wasn't built overnight. The railroad system wasn't built overnight. This is all going to be progress. And so the bigger thing that you really have to ask yourself, because California's made the decision. So on a lot of these fronts, when I say they thought it out, all of these things complement what their end goals are, right? It complements what they want to get to. They don't care whether you like it or not. It serves what they want to do. And the things you have to ask yourself are, do you think this fits your business model today with the opportunities from subsidized, funding and everything else that you can make it work in one way, shape, or form? Do you want to wait and let everybody else do the testing and hope that the cost comes back down in the time where you're being mandated to use it? Those are the real things you have to ask yourself. But at this point in time, I mean, if you at all belong to the Harbor Trucking Association, the California Trucking Association, you listen to the drum circles and the smoke signals, and you've listened to the fact that they've said this is coming before the end of last year. Don't bet on the lawsuit. It could happen. It could not happen. Go buy some diesel trucks if you can't do electric, because starting next year, you may have to do it. It's really about keeping yourself educated, understanding what your operations needs to be successful, but they don't give a flying truck whether or not your company goes out of business. Their ultimate goal is to have zero emissions trucks and employee truck drivers throughout the state of California. And listen, there's a reason that I got into zero emissions, because I do think it's coming. And I also would like to be part of the trailblazing of it. But understanding that once upon a time, I was Matt Schrap, and I understand the pains that each of you go through. And that's really what it's about. It's about understanding, again, the feedback of how you can and cannot do this, and pushing back on the things that don't make sense that get in the way. It's not about trying to make things to all people yet. They'll do that for you over time. And we'll do closing remarks and then go have some fun, please. Toni.
Thank you, everyone, so much for coming. I actually printed out a bunch of these guides in case anyone's interested. I'm happy to give you one. Thanks for your time.
Yeah, absolutely. Thank you. And thank you to PortPro for the sponsorship. And thanks for everyone's patience with I think it's indicative of this is what we deal with in California. While I would say pay people $5 more to clean up German tourists, feces that they leave on the floor, I don't think that's asking too much. But we have a lot of challenges ahead of us, and we are collectively here as an ecosystem to work together. Sorry, I didn't mean to